Hey guys, welcome back to the channel, your number one source for income-oriented investing. Super quick video here, no editing whatsoever. I'm just gonna wing it. I've been getting a lot of questions lately on the JEPY and QQQY ETFs. How risky are they? That's the main question. How safe are they? How do they work? What you could expect. So if you look it up on YouTube, you'll see a bunch of finfluencers in quotes having a field day on these. They're very they're very easy or hot to talk about because of the high yield. I'm sure there's a lot of nonsense about them. A lot of people, I watched a few of them, not many. You could see these nonsense, these crazy thumbnails. Here's my video, by the way, where I actually do a quick review of the video of the two ETFs and actually speak to Sylvia Jablonski, which I'm going to show a couple of clips from her interview on MSNBC in a second for 20 minutes about these. So I strongly suggest you check it out. Go into detail about these ETFs, but other people have been trying to kind of do the back testing themselves and trying to see how it works. I think the best one is probably Average Joe Investor, which is this one here. He got 126,000. He actually shows the options chains, and he basically tries to simulate what these ETFs do. But you could get very confused very easily with this. So the point of this video is to try to explain what kind of risk, what kind of risk profile do these two ETFs have, and what you could really expect. So again, listen to what Sylvia says on this interview, and we'll pause it because there's some very important key points where she describes the risks and how these ETFs work. Let's take a listen.
Then it'll come
So
in.
what kind of dividend do you think you're going to...
Yeah, annualized.
It depends on the market.
Yeah,
I mean, you don't know,
depends on
right?
the market, right? So if we back tested it from the time that these were in existence, which was 2022, and we compared that.
So you cannot back test these before 2022 because daily options came out in 2022.
To some of the other strategies out there, the QYLDs, the JEPYs of the world.
So she's comparing them, of course, to your classic cover call ETFs. QYLD is the NASDAQ one, or JEPQ, JP Morgan has, or JEPY, which is JEPY from JP Morgan, which is the most popular cover call ETF, tracks the S&P 500. So she's comparing them to those ones now.
And, we're looking to return 2 to 2.5 times that, because what happens is with those strategies.
So when she says looking to return 2.5 at least, where she's not talking about the return, she's talking about the yield, okay? Yield does not mean return. Very important.
Which are actually a very similar risk profile. That's another point that we can talk
Similar risk profile to those ETFs.
about too. It's super interesting, but we've heard a lot about how risky this is. The risk is pretty similar to a covered call strategy, right? But
there it is.
What happens is that every day we get a chance to take a little bite of the apple and generate premium instead of just kind of being locked in for that monthly call.
It is a covered call.
That is the main advantage and innovation that I see with these two ETFs compared to covered call ETFs that typically do the options monthly. You have it daily here, so it resets every day, so you have more of a chance to outperform, right? Outperform what? Let's see what she says.
Premium, essentially, but it's a daily.
Yes, exactly,
Right.
exactly.
Right. No, so it's easy to see why these options have exploded this year, folks. Think about what this does. This gives active traders more ways to play the market. It's a one-day bet. So you win or lose.
Just, he's talking about the daily options. He's not talking about the ETFs, okay, by the way.
Same day. It's cash settled, and that's very important. You don't get stock, you get cash. And so you get this dopamine rush if you win on a daily basis. Then you can do it all over again tomorrow. So I guess the problem we have, and here's a little summary about how they work here. The criticism out there, and even Gary Gensler at the SEC has said this, that this encourages market timing and day trading. And
not the ETFs, the options. But listen what she says when we're talking about the risks here.
we know the vast majority of people are going to lose money doing this. Gensler's written about increasing gamification of trading. You know about these kinds of criticisms. I know you're providing a product to the market, but what do you say to that?
Yeah, exactly. And what's really interesting is that the covered call strategies don't really get that same bad rep, but this is the same thing. It's just sort of.
But
it's the same thing.
Daily thing. There is this dopamine little rush of a daily bet.
There is for sure, but
this guy's talking about traders who use the options. He's going off script here instead of talking about the ETFs themselves, but she's obviously going to redirect back to the ETFs and their purpose.
I would say is that strategy has essentially just been turned upside down with the realization that, like, hey, you can actually generate daily income and perhaps outperform those strategies. But what I'd like to say about this is, and we talked about this before, this is something you can do in a retirement account. Like, we're holding cash.
This is something you could do in a retirement account. It's not risky. It's not a risky strategy.
Short-term treasuries that return 5%. We're selling in the money puts that are cash settled. So, worst case scenario, you have the risk of Qs, of the NASDAQ, or, JEPY
right. There is
on
limited
S&P.
loss.
There's the key. You have the risk of the NASDAQ, right? The Qs. When she says you have the risk of the Qs, she's talking about QQQY has the risk of the NASDAQ 100. The Qs is triple Qs is the NASDAQ 100. So you have the risk of the underlying, which is the index. That's basically the main risk. And for a JEPY, it's going to be JEPY. It's going to be the S&P 500. So it's pretty simple, guys. It's the risk profile is pretty much the same as a covered call ETF. They're just doing it in an innovative way. And the proof is in the pudding now. Let's look at actually how these behave. So this is something I suggest you do and has helped me really figure out, how do they move compared to the index, compared to JEPY. So what I did is in my stock phone app, I put the SPY, which is classic S&P 500. This would be equal to a VFV or VOO, same thing. SPY was just the first one that came out. So your classic S&P 500, I even put SPY and JEPY, your S&P 500 covered call ETFs. And then I put JEPY, and I did the same thing for the NASDAQ. So QQQ, which is your classic NASDAQ 100 index ETF, JEPQ, which is the JP Morgan NASDAQ covered call ETF, very popular, gaining more momentum and is actually going to beat QYLD very soon in terms of AUM, in my opinion, and then QQQY. So I've gone through, or I saved multiple days where the market was behaving differently. So number one, as you can see here from the title at the top, this is when the market goes up a little bit, right? So the SPY is up 41.41, SPY 0.29, JEPY 0.32. This is normal, right? If the market goes up, the covered call strategies will go up a little bit less. It's always that sort of behavior because they're giving up some upside. Covered call strategies are giving up some upside. So it's normal. You see 0.29, 0.32, a little bit less than the SPY. But then you see JEPY at 0.42. So it actually went up a little tiny bit higher than the SPY. So that is that daily premium that is helping the net asset value of the fund to basically go up, right? So you could see the behavior here. So when the market is up a little, it's pretty clear that JEPY is a winner, right? It's doing really well. Look, what about the NASDAQ? Up 0.71, so a little bit higher, 0.71. JEPQ, same thing, right? Up a little bit less because it's a covered call ETF at 0.51. And then you have QQQY at 0.58. So this one is the NASDAQ up a little more than the S&P 500. So you could see there's a little discrepancy. So QQQY will pretty much, and JEPY will pretty much perform or do what the index does, what the NASDAQ does or what the S&P 500 does, except if it goes up a little bit higher instead of just a bit. You see here a bit 0.41. It's fine. It's the same pretty much. But 0.71, it lags a little bit, but not by much. 0.58, higher than JEPQ. Let's look at the next day, which is up. This is a day where the market is, up substantially. So you have the S&P 500 up 1%, the NASDAQ up 1.13. JEPY, what does it do? As expected, up a little bit, but less than the SPY, and you have JEPY up 0.53. So this is where it doesn't do as well. So exactly like a covered call strategy, right? It doesn't do as well as JEPY in this case because the option strategy is a bit more aggressive, so you're getting more premium, but you're giving up more upside. And they're always I talked about it with her, they're trying to make 0.25 every day. So NASDAQ 1.13, JEPQ up a little bit less, of course, 0.80, and you have QQQY not far behind 0.75. Here's another up day Not as much as the last one, up 0.75, up 95 here. Same type of deal. The cover call and JEPY here are up a little bit, but just not as much. Same thing, right? So you have QQQY, you see up 97, you have 0.49. So they're very, very similar. They behave very similar in an update to a covered call strategy. The more the update is, probably the worse off it is for JEPY and QQQY, because you're giving up the upside, but you're getting that premium, right? So let's go look at a flat day. So this is where it shines, because a flat day, when the market does nothing, the S&P 500 it does nothing. This is where the cover call or the option strategies will go up a little bit. These are the premiums that, if the market is doing nothing, well, the covered call, the options ETFs will win for sure, right? So you see QQQ minus 33, JEPQ and QQQY minus less, right? So in this day, when the market is flat, these options ETFs will always be a winner. It's really only when the market is up substantially or medium to substantial where they give up some of the upside, where you could say they don't win. But when the market is flat, they will win. When the market is down, they will win, because that option premium cushions the decline. So you see here, the SPY, this was a down day, minus 88. You have JEPY and JEPY down less because that premium helps. Same thing for the NASDAQ that day. You actually see QQQY and JEPY are down. They're the big winners here, right? Minus 94, JEPQ only minus 53, a bit less because of that option premium, and QQQY even less, 0.37. So if we look at a down hard day where it down more than 1%, you'll see the same type of deal. The SPY is down 1.33. JEPY and JEPY are down 1 point, they're down less, 1.30 here, minus 1.99, minus 1.16. Another down hard day, you'll see the same type of behavior. If the SPY is down 1.23%, the option ones are going to be down less, because the cover call premium or the options premium helps to cushion the fall. Same thing on the NASDAQ here, QQQ minus 1.5, big down day here, minus 1.19, but only minus 1.08. Down very hard, here's a down very hard day, minus 2.45 on the NASDAQ percent in one day. It's pretty sharp fall, minus 1.44 on the SPY, and you see the same type of behavior. JEPY is going to go down as well, but just not as hard, because that premium helps to cover the fall. You could see here minus 2.45, JEPQ minus 2.11, QQQY only down minus 1.88. So that daily, that nice big juicy daily premium helps to cushion the fall. So this is what we could expect going forward. I see some videos where they say there's a big down day, it's going to be a disaster for them because their puts. It's not true. I mean, look at the evidence here. So what can you expect with these ETFs? What do I expect going forward? That they will outperform during that day, during a flat or down or slightly down or very hard down day. QQQY, JEPY will always do a little bit better. And even the covered call ETFs, they behave the same way because of that premium. Where they underperform is the same time where covered call ETFs underperform when it's an up day or a strong up day, because you're going to give up some of that upside. It's during a flat down day where they shine. So I hope this video was informative for you. I mean, for me, this is a very boring strategy. It's very similar. Like she said, it's similar risk profile to a covered call ETF like JEPY and QYLD. The main risk is the underlying index. That's why I love them so much, because I love index investing and I love the S&P 500 and the NASDAQ. That's really what your ETFs are going to do. And again, I strongly suggest, if you haven't checked out this video, I spent 20 minutes discussing all this with Sylvia. So hopefully this clears up the air. I don't want you to be scared about these ETFs. You'll see a lot of these scary thumbnails, which of course people are attracted to for some reason, but the reality is these are boring ETFs. And if you don't believe me, Do this exercise yourself. Put these in a row and you'll see the behavior for yourself. So see you next time.